right, so we're going to cover a lot of ground in 15 minutes. So very humbling. We'll touch on the equity market, the bond market, the economy, the corporate earnings, and the sector valuation. So we're going to do all that in 15 minutes. My slides are about a week and a half old for the most part, so the chaos of the last 3 days in the markets are not captured on these slides, but the story probably doesn't change very much. So the first thing to point out, if you look all the way over on the right-hand side here, and you price the world in US dollars, the US market for the first time in more than 15 years is not the dominant performing equity market anymore, nor is it the dominant performing bond market. And if you price Europe, Latin America, and Asian markets in US dollar terms, you've got a year-to-date performance of somewhere between 20 and 50%. Compared to the US performance as of a week ago, up 14%, obviously up less now, is more or less in line with the weakness in the dollar. This performance this year has had a meaningful impact on how investors allocate their funds between the US and abroad. That's our US dollar year to date. So I think more importantly, if you're a non-US investor, your equity returns in dollars are pretty close. If you're a non-US investor, you're based in Europe, you're based in Asia, your non-US returns are pretty close to zero, and your bond returns are negative. And we'll get back to why this is important, because we've had the luxury of being the go-to market for 15 years. We've also had the luxury of having foreign participation in our US Treasury auctions that historically have represented about a third of the demand. If I do a quick snapshot of how the retail investor is positioned, and you think about this notion of a 60-40 model, 60% of my money in equities and 40% of my money in cash and bonds. At 68-32, we're a long way from normal. And just to give you a historical perspective of what normal has been, if I look at retail equity positioning over the last 30 years, we have spent 80% of the time between 55% of the portfolio and 70% of the portfolio invested in equities. So we are, as a retail investor, we're heavily invested in equities. And the retail investor polls very neutral right now. The institutional investor, and Deutsche Bank puts out a great weekly piece, if any of you have access to it, their equity positioning note. From a institutional point of view, the average institution is about 75 percentile level of equity ownership, but the average institution is less neutral than the retail investor. They're actually slightly bearish. So we have a modest gap between how investors are positioned and how they see the market. So three things can happen. We can stay with a modest gap, we can get more bullish, or we could reduce the equity holding. So we've got three choices. And when investors are asked about their perspective, it's usually on a 6 to 12 month basis. "2020 was the biggest issuance year in the history of the world." And so I've got the bar for 2020, which is investment grade and a high yield corporate issuance in the US. So here we are 5 years later. those bonds are maturing. If I put Term Loan B loans in there as well, that would take that issuance closer to $3 trillion. So just to do the math, in the US, we've got roughly $3 trillion of corporate debt maturing in the next 12 months. We've got $8 trillion of US Treasuries returning in the next 12 months. But at the run rate of the deficit we're running, we'll probably issue $3 or $4 trillion on top of the 8. So the bond markets all by themselves will have a need for something like $15 trillion of buyers in the next 4 quarters. So let's hope that foreign investors still buy our paper, and maybe central banks have to switch and become buyers and not sellers at some point. I just wanted to give you a little snapshot, and this has been really consistent. So where is the money going? This is actually a pretty good year in terms of investors putting money into funds. The big winner in Q1 was European equities. And the big winner since Q1 has been US bonds, and in particular US bond funds, and a lot of that is passive. So a lot of that's going into the biggest bond issuances, which is good news because, as we just saw a minute ago, we have a lot of paper coming due. So it's great that investors in the US are pouring a lot of money into bond funds. And so if you look at the pink, and I'm sorry, I apologize in advance about the colors. We acquired Carnegie earlier this year, and the combination of D&B's colors and Carnegie's colors. So you can see a lot of versions of pink and green and lots of shades. And so this isn't the worst slide. There's a worse one coming up. So if you're colorblind, I'm sorry, you'll just have to listen to me. But you can see how the bond funds have had really good inflows, and you can see how the active equity funds have gotten killed. So if I throw in what's going into equity ETFs, it's still not positive. It gets it closer to 0, but it's still not positive. So this is my first scary chart. Japan's 30-year bond, and they've got an interesting period of time ahead of them in the next 3 weeks. They're going to pick a prime minister who will probably want to stimulate. You've got a Bank of Japan that said last summer they were going to raise rates at the October 30th meeting. But if your government is stimulating and your central bank is tightening, we've seen the Liz Truss moment. We saw what happened in August the 5th last year in Japan. We saw what happened when Powell said inflation isn't transitory anymore. So we've seen what happens when we have a fiscal stimulus and central bank tightening. The last 3 episodes didn't go very well. This one, second quarter, not updated for the more recent revisions. So we have had 4 years, starting in the second half of 2020, maybe even 4.5 years, all the way through the end of 2024, where our GDP was driven by 2 things. It was driven, number 1, by consumer spending, and it was driven, number 2, by government spending. So you can pick out the colors. This is the one I'm really sorry about, by the way. So you can pick out the colors, and you can see that consumer spending, which was enormous in the past, isn't so enormous now. Even if I mentally put the revisions in, consumer spending in the first half of this year was up about 1.5% year on year. Business investment better work because the big, beautiful bill told us our target is 4% GDP. Well, you've got 3 big buckets, and the big buckets for this year historically aren't big buckets. We'll get to that in a second. But the big beautiful bill, which hopes and promises for 4% GDP, consumer spending at 1.5% isn't going to get us there. Government spending at zero or negative year on year isn't going to get us there, and so that puts an awful lot of pressure on business investment, which is less than 20% of GDP. It puts an awful lot of pressure on business investment to fill that gap. And so what did we have in Q1? We had the biggest import quarter in the history of the United States, ahead of those feared tariffs. And we built up inventories, and so we had a negative GDP. What did we have in Q2? We didn't import anything. I know that's an exaggeration. We just had a container panel up here, but stay with me. So we imported almost zero in Q2, but we sold out the inventories. Just listen to the CEO of Walmart talking about his business development between Q1 and Q2. So we haven't really felt the effects of the tariffs yet because we've been selling out inventory that was purchased 2 or 3 quarters ago. But that's not a sustainable model for GDP growth. I'm pretty sure that we're going to import again, and I'm pretty sure we're not going to build up inventories at the rate that we built up inventories in Q1. So I don't see that as the sustainable business model. So we have a slow growth economy. This is my second least favorite chart. These are the 20 to 24-year-old graduates coming out of school. So now I'm done with the bond market. I'm moving to the economy really quickly now. We didn't get the labor statistic on this a week ago Friday. Expectations were that that number was going to be closer to 11%. This is the first time that we have unemployment of people, young people coming out of school, unemployment over 10% without being in a recession. So this notion that that unemployment just showed up this past summer is nonsense. And if you looked at ISM manufacturing employment, that's been trending down for 2.5, 3 years. But we're a services economy, so if you look at ISM services employment, every time I'm not sure which way a chart's going, I show it to my grandsons and they go, Grandpa, that's going down. So ISM services employment's been going down for 2 years. So this notion that employment just became a problem this past summer is crazy. Earnings quickly. The earnings picture is getting really complicated. In the fourth quarter of last year, we had earnings growth of 18% year on year, but a lot of that was just because we pulled economic activity forward. Each quarter since then, we've been drifting down, but the earnings picture is still phenomenal. This quarter expectations are for earnings of 8% growth year on year. It'll probably be better for that, but if consensus is correct, the Magnificent Seven earnings growth will be up over 18%, and the other 493 stocks will be up less than 3% in terms of their earnings growth. And if I decide not to take the Magnificent Seven and I just take the 6 largest technology stocks in the US, their earnings growth is up more than the Magnificent Seven, and the rest of the market is going to be up something closer to 2%. So this is not so we do have earnings growth, which is phenomenal, but it is heavily concentrated, and the companies that beat estimates in the last quarter did okay, and the companies, so 80% beat, 20% missed, the companies that missed last quarter got killed. Good, I'm going to make it. So now we look at valuations over time. And Warren Buffett's a big fan of the right-hand column up here of market cap to GDP. So over the since 1998, market cap to GDP, we're in the, 97, 98th percentile? My favorite is EV to EBITDA, except when you look at the banks, because it's hard to look at the banks without looking at interest. But EV to EBITDA, we've been hanging around 16, 17 for the last couple of years. In the year 2000, when the market peaked, EV to EBITDA was 14. We're expensive. And then everyone looks at price earnings. I find it to be the least interesting, but price earnings, it doesn't look quite as bad. And then if I look at sectors, technology sector at 26 times EV to EBITDA, real estate, and then you look at things like energy all the way down here at 8 times, and for the shipping industries, their valuations tend to be similar to the way energy is valued, as opposed to how industrials are valued. And so the shipping and energy industries are relatively cheap. And if I look at the world in price to book, it is amazing to me that we are still trading at 5 times price to book in the US when the rest of the world trades at 2. The valuation gap between the US and the rest of the world is amazing to me, and I can't go into all the components that have gotten us there. But I have used up my time. I appreciate you listening, and I hope we have some wisdom down in Washington at the US Treasury. Thank you.